In January of this year, silver touched an all-time high of $121.67 an ounce. By the middle of this year, it had fallen nearly in half. This week, it closed back above $69, up nearly 5% in a matter of days, and gold closed the week above $4,600 for the first time. That's a genuinely wild round trip for one metal to make inside a single year. And in exactly 7 days, on Friday, August 28th, the man now running the Federal Reserve steps up to a podium in Wyoming for the first time since taking the job, in the one venue the Fed has historically used to signal real shifts in direction. I want to walk you through how silver actually got here, what happened this specific week that most coverage is explaining wrong, and why the next 7 days carry more genuine dated event risk than almost any other stretch this year. Quick disclaimer, I'm not a financial advisor. This isn't a recommendation to buy or sell anything. And both metals have shown real, sometimes brutal volatility in both directions this year. If that context is useful to you, subscribe and tell me in the comments, are you holding through Jackson Hole next week or watching from the sidelines waiting for more clarity? I want to know where this audience actually stands. Let's start with the round trip itself, because the shape of it matters more than either number alone. Silver's January 28th peak of $121.67 came during a period of acute stress Middle East tensions, fears that an oil shock would reignite inflation, and a broad flight into hard assets with no counterparty risk. Gold hit its own all-time high the same day, just under $5,600. Since then, the two metals took very different paths. Gold recovered a meaningful share of its correction relatively steadily. Silver fell further and recovered more slowly.
Gold doesn't scam anyone. People do. Fake urgency, coins with fancy names and inflated prices, fees buried so deep you won't find them till it's too late. That's not conspiracy talk, that's the actual playbook, and it's been running on people for decades. I wrote a book to break that playbook wide open, The Precious Metals Trap. Not a sales pitch, not another buy gold now video, just the real tactics, the real red flags, and the exact questions that expose a bad deal in seconds. Whether you're just starting out or protecting decades of savings, this is the one read that puts you ahead of the pitch, not behind it. Comments, description, both. Now, back to the topic.
In large part because roughly 60% of silver demand is industrial solar, electronics, EVs, which makes it more sensitive to fears about a slowing economy than gold is. That's the entire reason silver's round trip looks more dramatic on a chart than gold's. It isn't a different metal behaving irrationally. It's the same monetary story playing out with an extra industrial demand headwind layered on top. Now, here's what actually happened this specific week, because it's more interesting than gold and silver went up. On Wednesday, the U.S. Treasury announced it was significantly expanding its long-end bond buyback program, buying back some of its own longer-dated debt, which under normal circumstances pushes those bond prices up and yields down. And here's the part almost nobody's explaining clearly. It didn't work that way this time. Despite that buyback announcement, the 10-year Treasury yield closed the week at its highest level in 20 months. Markets largely brushed off a move that would ordinarily be expected to cool yields off. On that same day, U.S. national debt crossed $40 trillion for the first time, and the government's own long-term borrowing costs hit a two-decade high. Think about what that combination actually means, because it's the whole story of this week's rally. A government intervention specifically designed to hold yields down failed to hold yields down, landing in the same week the national debt crossed a genuinely historic threshold. Traders didn't read that as a sign of fiscal strength. They read it as a measure of eroding confidence in the U.S. government's own debt and currency. And that reading is exactly what sent gold silver, and even Bitcoin higher together by the end of the week. That's a meaningfully different mechanism than 2 weeks ago, when a similar Treasury operation actually did pull yields down and lifted metals through the ordinary opportunity cost channel. This week, the metals rallied for closer to the opposite reason, not because rates looked set to fall, but because the bond market itself looked less trustworthy. There's a second layer sitting underneath this, and it's worth knowing before we get to next week. At the Fed's July 29th meeting, the committee voted 9-3 to hold rates steady at 3.50 to 3.75%. Three regional Fed presidents, Beth Hammack, Neil Kashkari, and Lori Logan, dissented, wanting to hike immediately. That level of open dissent, this early in a new chair's tenure, tells you there's a genuinely vocal minority inside the Fed who think holding steady is already a mistake. And it's not just three people. Back in June, 9 of the 18 Fed officials who submit economic projections penciled in at least one more hike before the year is out. That's half the committee, on record, leaning hawkish going into a period where inflation data has actually been cooling. That tension a committee that's nominally on hold but internally closer to a coin flip than the headline vote suggests is exactly the backdrop Warsh steps into next week. So why does Jackson Hole specifically matter more than a normal Fed speech? Kevin Warsh has been chair since May 22nd of this year, and this is his first appearance at the one event the Fed has historically used to signal real, structural shifts in direction rather than routine guidance. He told reporters after the July meeting that he wants his remarks to focus on long-term structural questions rather than near-term policy signaling. But he's also been explicit that the Fed will act independently of what markets are currently pricing. Right now, markets are pricing something in the mid 30 seconds to high 30 seconds % range for a September hike. Warsh has effectively told you in advance that number doesn't bind him. That's a genuinely different posture than a chair who telegraphs intentions ahead of meetings. And it means this speech carries real, undetermined information value rather than being a formality. Let me give you both realistic outcomes honestly, because a setup like this deserves the complete picture, not just the exciting version. If Warsh's tone leans toward acknowledging the cooling inflation data of the past 2 months and signals patience that reinforces the current lean toward a September hold and is historically the kind of environment that supported further gains in both metals, especially with the debasement trade reading from this week still fresh. If instead he uses this platform to establish inflation-fighting credibility early in his tenure, deliberately surprising a market that's gotten comfortable with a dovish lean and giving weight to the 3 dissenters and the 9 hawkish dot plot participants that would push hike odds back up, likely strengthen the dollar and put real pressure on both metals, probably within minutes of him starting to speak. Both outcomes are genuinely plausible. Anyone telling you they know which way a new chair leans in his first major address is guessing. There's a structural force sitting underneath all of this that doesn't depend on what Warsh says at all. Central banks bought 288.9 tons of gold in the second quarter of this year alone, up 62% year over year, the strongest second quarter on record, according to the World Gold Council, and they bought through a quarter when gold prices were actually falling. That's not a reaction to any single headline or speech. It's a sustained, multi-year institutional decision, and it's part of why gold's floor has behaved differently this cycle than in past corrections. Whatever Warsh says next Friday, that buying pattern doesn't reverse on the strength of one speech. Now, the honest risk in both directions, because both metals remain capable of sharp moves that reverse quickly. Silver, in particular, carries more volatility than gold, given its industrial exposure. It tends to move harder in both directions on the same news. This week's rally, built partly on a bond market confidence story rather than a simple rate cut story, is a genuinely different kind of move than the ones driven by straightforward opportunity cost math. And different kinds of rallies can unwind differently too. If Jackson Hole delivers a hawkish surprise, expect real pressure on both metals. And if the 10-year yield keeps climbing regardless of what the Fed says, that would suggest this week's erosion of confidence story is deepening rather than fading, which is a different risk entirely from an ordinary rate-driven pullback. So here's what I'd actually watch concretely over the next 7 days. First, the 10-year Treasury yield itself, if it keeps climbing even after Jackson Hole, that tells you the debasement trade reading from this week is the dominant story, regardless of what Warsh says about rates specifically. Second, the US dollar index, since a continued slide alongside rising metals would reinforce the same story. Third, any public comments from other Fed officials in the days before the 28th, since central bankers often signal directional hints through multiple voices before a chair's major address. And fourth, obviously, Warsh's actual tone on Friday, whether he leans into the structural framing he's promised, or whether the three dissenters and the hawkish dot plot end up shaping his language more than expected. I'm not telling you silver retests $121 or falls back toward its correction lows. Nobody can responsibly promise you either outcome. And this week's rally, however dramatic, is still 1 week of price action built on a genuinely unusual mechanism. What I am telling you is that silver's round trip this year has a real explainable shape to it. This week's move had a specific and slightly different cause than the rally 2 weeks earlier, and the next 7 days contain more dated, foreseeable event risk for both metals than almost any other stretch this year. Tell me in the comments, do you think Warsh leans toward confirming the market's current dovish lean, or does he use his first major platform to push back against it? And once Jackson Hole wraps, I want to know whether you think this week's debasement trade story held up, or whether a simpler rate story took back over. I read these, and I'll be back the moment Warsh actually speaks. If this helped you understand this week's move, instead of just watching the number climb, subscribe 7 days from now. We'll know a lot more than we do right now.